1. Business quality and moat. What Gamehaus does? Gamehaus is a mobile game publisher. They partner with small to medium game developers. They help distribute, monetize, and promote games and app purchases. Ads, rather than building all content themselves. Competitive advantages / possible moat. Buffett likes simple, durable advantages. What might Gamehaus have? Platform and relationships. If they have strong relationships with developers and a good track record, they may attract developers who prefer to outsource publishing. Data analytics for monetization and user acquisition. They claim to be technology-driven. If their analytics, user acquisition efficiency, ad monetization, and retention are strong, that could be a differentiator. Weaknesses to its moat / durability concerns mobile gaming is highly competitive, with low switching costs. A developer could switch publishers or self-publish, trends shift fast. Monetization models, app store rules, platform fees, and user tastes. What works today may be obsolete tomorrow. Their newer titles and monetization initiatives are still in testing. While legacy portfolio is already mature, declining. Conclusion on moat: they may have a modest moat around operational execution UA. Monetization, developer partnerships, but not much barrier to entry or cost protection. Durable, unclear. They must constantly innovate. 2. Management, quality leadership, credibility. Founder Feng Zhe is chairman and director. The company seems engaged with investors and is trying to pivot new titles, exploring new monetization. When legacy titles decline, but the scale is small. Margin for error is low. There's no evidence of star management pedigree. Capital allocation skill: they have reduced user acquisition marketing spend. When returns decline, reasonable discipline. They also initiated a share buyback program, $5 million United States dollars, which could indicate management believes shares are undervalued. But at such low market cap, buybacks may have limited effect. Shareholder alignment: insider ownership is high. Insiders hold a significant share, which tends to align incentives. But risk remains. With small cap liquidity issues, management might take riskier moves. 3. Financial strength metric. What I found Buffett would like notes. Concern. Revenue growth: revenue has declined for 9 months, ended March 31, 2025. Revenue was $87.4 million United States dollars versus $113.6 million United States dollars, same period prior. Approximately 23% drop. Also TTM revenue $118M. Prefer steady or rising revenue over many years. Decline is red flag. Decline likely due to mature titles and reduced marketing spend. Might be temporary or a structural issue. Profit margins, gross margin, approximately 52.7%. Net profit margin, approximately 3.36%. Operating margin very slim, approximately 2 to 3% and falling. Prefer healthy margins, rising or stable, not razor thin. Margin pressure from UA costs, platform cut, declining user numbers. ROIC, approx 11.38%. ROIC approximately 6.2%. Buffett likes ROIC, well above cost of capital, sustainably say 15% plus. These are modest. Could improve, but not currently outstanding. Debt levels, leverage very low debt. Debt equity approximately 0.02. Net cash plus modest debt. Good low debt reduces risk, especially in volatile business. But small cash buffer. New titles cost heavily in dev marketing, might need capital. Free cash flow: operating cash flow 9 months $0.8 million United States dollars versus prior period US $3.7 million. Free cash flow weak or nearly break even. Buffett prefers strong, stable free cash flow. Here it's fragile, risk if unexpected costs come. 4. Intrinsic value given limited data. Any valuation is rough. Still, applying a simple owner earnings DCF thought exercise, net income, TTM, $4 million on $118 million revenue. Suppose earnings stabilize and grow modestly, 5% per year for next 5 years, tapering to 3%. Assume modest margin improvements and manageable reinvestment costs. Discount rate, 12 to 15% small cap gaming risk. DCF sketch year 1 earnings, $4 million, year 5 earnings. Tilde, $5.1 million, terminal value. Tilde, $58 million. PV of years, 1 to 5 earnings. Tilde, $16.18 meters PV of terminal. Tilde, $33.35 M total intrinsic value. Tilde, $5 M, with approximately 53.6 meters shares outstanding. Intrinsic value per share is around 90 cents to 1.000 compared to market price. Tilde 1 United States dollar and 40 cents to 1.50 per share. The market appears to be overestimating growth or underestimating risk. Some models peg fair value closer to 39 cents. 5. Long-term prospects industry outlook. Mobile gaming continues to grow globally with a huge addressable market, increasing smartphone penetration, and more monetization via ads and in-app purchases. But competition is brutal. Platform fees remain high. Policy risks like privacy changes and ad tracking restrictions can hurt user acquisition. Risks: declining engagement, retention in legacy titles, dependence on outside developers with low hit rates, rising marketing and UA costs. Now, volatility and liquidity issues as a microcap stock. Can it compound capital for 10 plus years? Possibly, if they bring out successful new titles. They improve monetization metrics, RPDO retention, conversions. They control costs and avoid overspending. But with declining revenue and fragile margins, long-term compounding looks uncertain. 6. Final verdict: Buffett-Style. Checking Buffett's checklist. Understandable business, yes. Consistent earnings, no. Earnings small, margins thin, revenue declining. Good ROIC, modest, not outstanding. Low debt, yes. Attractive valuation, no. Current price looks stretched. Long-term moat, weak or doubtful. Verdict: Gamehaus Holdings is not a strong Buffett-Style buy right now. The valuation is too optimistic. Earnings are weak and declining, and the moat is fragile. It could become interesting if management reverses revenue decline, launches successful new titles, and strengthens free cash flow. For now, the stock fails Buffett's core tests.